Hey guys, in this video I'm going to look at 5 ways to trade without stops. Stay tuned. Hey traders, warm welcome to you. So, controversial subject this, stop losses. We talk about stop losses all the time, stop loss placement. And for most of us, that makes a lot of sense, right? We want to manage the risk on the trade, we want to place a stop. But sometimes we get into a situation where stops are not helping us at all. There are other ways of managing risk. Now, don't get me wrong, guys, we have to manage risk. I'm not saying just go crazy and just trade wildly and don't use stops or don't use some way of managing risk, because risk management is important. Without it, we end up wiping out. However, there are other ways to trade and manage risk without using stops in the way that most people use them. So in other words, you're kind of selling a double top, you put your stop above the high. Without doing that, how do you trade without using stops? Because I've done another video, a couple of videos on this topic before, and if you're subscribed to the channel, maybe you've seen them. If you're not, go and have a look at some of the kind of video content, have a look through the library. Got loads of videos in there talking all sorts of different subjects and topics. And if you're kind of really interested in understanding supply, demand, and how price moves, and understanding gaming theory, and sort of looking at the markets in a different way. But anyway, regardless of that, we often fall into the trap of putting stops too tight, and they can be detrimental to our trades. Not always, and now some people trade very, very successfully with stops, but it's just something, another angle to look at. And I'm always open-minded myself to other ways of trading. It might not kind of resonate with me, or it might be like I take something and implement it into my strategy. Okay, so the first thing is if you trade small size, so you can manage your risk with size. If you've got an account size of X, if you're trading, a small size that really it doesn't matter so much the account, then really how much damage can the market do to you? If you're such a small position, then it's not going to damage you, even if it just goes against you massively. You're not going to have so much hurt that it damages the account. Now, of course, the downside of that is if you're trading so small, then the wins become almost meaningless. However, you could argue that because you're not getting stopped out so often, that the wins are more frequent. So that's something to potentially consider, reducing your position size so that the hurt or damage on a trade isn't so much, and kind of trading it from that angle. The other one is to have some kind of exit anyway. So again, if you've got a position size that's not going to hurt you, no matter how much you can do in the day. Let's say you're day trading. So the 1 day's range is never ever going to kind of wipe you out. Might not like it if you get on the wrong end of it, but it's never going to wipe you out. But having an exit point so that you're not in a trade forever and ever and ever is quite a good thing. So you could trade without stops. Let's say you're trading long or short intraday. And the kind of stop, if you like, is the close. So whatever happens at the close, if you're still in the trade, you're out. If you're swing trading, maybe that's the week, maybe that's the month. So, the worst case scenario is you just get it wrong straight away. It just goes against you massively and never comes back. And you don't cut it at any point because you just think it's going to come back. So the worst case scenario is that you exit the close. How much damage is that really going to do to you? As long as you're trading small enough, probably going to be okay. But don't forget, the idea is that, we'll get to that in a moment, the idea is that you're just judging the position as it goes and using your judgment and skill to say, well, actually, you know what, I bought this thinking we were going to bounce on that low, and we've actually turned into a horrible grinding downtrend there. I don't want to trade anymore. Cut it, take your loss, take your medicine, move on. But you've got that emergency there. On the emergency themes, have an emergency stop. So if you want that safety net, then just put a stop loss in, very far away from the market to stop you from massive tail risk, some sort of news risk, some sort of catalyst coming out that just hammers the market, and also to stop, obviously, failure of your hardware, your internet, whatever it may be, a broker going down. If you've got that stop in, it might not always protect you depending on where the stop's sitting. But if the stop's sitting on the exchange, for example, then you'll be fine with that. At least you've got the safety net. So an emergency stop in place. The other thing is use a hedging strategy. Not a big fan of this myself, because I think that if the premise and the thesis of the trade is no longer valid, you need to ditch the trade rather than trying to be clever with it. But it works for some people. So in other words, you kind of, let's say you're buying the Nasdaq kind of went against you, and it kind of moving away. Rather than closing the position, if you're still bullish on that Nasdaq, didn't want to close it, you might hedge with, let's say, a short YM, a short Dow, short S&P, or whatever, hoping that was the weaker one, so that when the Nasdaq kicked back into gear again, the one that you were short on wasn't as aggressively moving, and you could peel that hedge off. So one way of looking at it. I'm not a huge fan of that, but I know it does work for some guys. Fifth one, guys, is to develop the skills to kind of trade that's not working. So use this in conjunction with all these. So you can say, right, I've got kind of worst case scenarios here. I'm trading small, it's never going to really hurt me enough. You know, even if I had another flash crash, it wouldn't wipe me out. And the chance of that is slim. And of course, it's 50-50 depending on which side I'm positioned. But having the skills to cut a trade. So like in that example, let's say, you know, we had, what am I drawing here? Let's draw the axis first. Let's say we had a market here that was doing this, and we bought kind of here expecting it to move back up, and then it just fell through the floor. Well, the trade's negated, and so using our skills and developing those skills to say, hey, yes, I did buy here for a double bottom play for a move back to here. It didn't work out. It's coming down here. I'm not just holding on for the sake of it and hoping it's going to recover by the close or to my emergency stop down here. No, I'm judging it and saying, you know what, thesis of the trade's wrong. It's looking weaker. It could recover, but to me, it's trying to change vibe now. We've stayed down here too long. It's not a spike. You know, it's changed. So I'm going to cut the trade. Bang, take the loss, move on. And so, you know, you're very much dynamically looking at the position. Yes, you've got your safety net in, whether that's a small size or closing at the end of the day, the end of the week, or having an emergency stop in place, but you're not allowing it to hit those very, very rarely. And that's the whole point of it. The idea is that you're using your judgment to exit the trade. So rather than maybe normal trade, if you bought here, you'd probably say, well, I'll have a stop here. That might be the level where you go, okay, well, that was where my stop would be. Let me put a kind of mental marker on that to say if it gets there, I'm going to reevaluate. I'm going to look at it. If I still want it, then I'll use my judgment and I'll keep the trade on. If I don't want it, then I'll still cut it. So we're not saying we'll never take losers here. We're just saying maybe look at things in a different light rather than just always coming out whenever it hits the stop. And then of course, if the stop's too tight, we get pinged out too soon. It's too wide, we end up holding it unnecessarily too long. Use a bit of skill, use a bit of judgment and try to work on that muscle, if you like, to judge when, you know, the trade's not really valid anymore. It's not really acting the way I should do. You know, use that price action skill set that you've got and you're developing and or your ability to read price action to say, hey, it's just not working out this. I'll cut it, I'll move on. So you're still gonna have losers, but it's just a different way of trading. So there's 5 ways, guys, to trade without stops. What have I missed? Stick in the comment section below. Let me know your thoughts on this whole thing of trading, you know, without a stop loss. Take care, whatever you're doing, and make sure you do keep the risk managed, guys. It's so important you do have some risk management in place because, you know, especially if you're kind of newer to trading in the first few years or whatever, you don't want to get wiped out. You want to preserve the capital because capital, financial capital and emotional capital actually is the lifeblood of trading. So make sure you do protect that whatever you're doing. If you like this kind of stuff, guys, thumbs up is much appreciated, as is your subscription, shares, comments. I know a lot of you guys need to support the channel and really do appreciate that. And while you're down there, have a look at the link in the description below to our channel sponsor. Well, there's a link to that in the description below. Take care, bye-bye.